Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Willy Walker, Chairman and CEO of Walker & Dunlop, to discuss opportunities in the commercial real estate market once rate stabilization occurs. Willy, it's great to have you with us. Welcome to Trade Talks.
Nice to be here with you, Jill.
All right, you got it. And before we get into the real estate market, I want to get your outlook on the markets overall as we head into 2023.
You know, we've had 7 rate hikes this year by the Federal Reserve, and that has obviously raised the cost of debt across all industries, and in the commercial real estate industry, which uses debt a lot, it has slowed things down precipitously. At the same time, there's anything but a crisis going on. What you're seeing is the transaction volumes have slowed. Credit quality is still very good, particularly in the asset classes that we lend on. And I think that there's a sense that people are waiting to see when we get to rate stabilization. And then as soon as the Fed stops its raising, I think that cap rates can adjust and transactions can come back.
So Willy, are you starting to see signs in the market that inflation is easing?
So Jill, when we saw the inflation print on Tuesday, I was quite optimistic. We had seen spreads coming in during the course of last week. We'd seen on the investment sales side, where we're selling properties, what we feel is price discovery at sort of a floor level. And then the inflation print came out, which made me believe that the Fed might do 50 and then another 25 and potentially pull out of the market. And then Chairman Powell, as you know very well, Jill, came out on Wednesday and kind of threw cold water all over that outlook, and the markets have reacted accordingly. And so I think one of the challenging things right now is that we're all seeing the data and it feels quite good. And yet the Fed is continuing with this very hawkish stance. And so it's extremely difficult to plan for 2023, given what the data is saying and yet what the rhetoric from the Fed is.
So once this rate stabilization occurs, do you expect to see more opportunities in the market? Let's start with the multifamily outlook, because that seems to be a spot that has been quite attractive for a number of years.
Yeah, multi is very strong right now, Jill. And as you know, over 80% of Walker & Dunlop's deal flow, both on the financing side as well as on the sales side, is in the multifamily asset class. And one of the big issues why multifamily has been so strong is because Fannie Mae and Freddie Mac are there to provide liquidity to the market when liquidity moves away from commercial real estate generally and asset classes like office and retail, which don't have the backstop of the GSEs. And so multi has been very strong. Rent growth has continued to be strong. It is tapered somewhat, but the outlook for rent growth in 2023 is still, I mean, it's one of the big components of inflation that many people want to see come down, and it's still sort of, begrudgingly north of 5%. And so until that comes down, that's one of the components of inflation that needs to come down to try and get some of these inflationary pressures out. But multi is doing extremely well. Cash flows are strong, occupancy levels are very high, and there is still rent growth for 2023 in multi.
Yeah, I mean, well, lack of affordability for home buyers is probably a big component of that as well.
That's a very good point. With mortgage rates as high as they are, and also with the cost of inventory going up, that sort of competitive offering from single family to renters really isn't there today. There's just too much of a gap between being a renter and being a homeowner because of the cost of home ownership. And so as a result, those people who we would call, graduating, if you will, from renting to owning a home or moving from one asset class to the next. Right now, that isn't happening. So that's keeping people in multifamily, which is keeping occupancy levels high.
Right. What's your thoughts on the commercial side?
It's more complicated, to be honest with you. Industrial is still very strong, and industrial is actually trading at extremely low cap rates. So industrial has somewhat of a conundrum that, if you're buying a great industrial property at a, low 4s cap rate and you're financing it with debt in the mid 5s, you've got negative leverage on that acquisition or on that refinancing. And so the industrial sector has to have some kind of cap rate adjustment to get it to the point where people are actually new investors and bringing new capital to industrial. But it's still, without a doubt, either the strongest or, with multifamily, one of the strongest commercial real estate asset classes. The others, retail has been actually stronger than many had expected. And there is capital going to retail, but we just saw a big loan default on a mall in upstate New York this week. And so, big box retail is still somewhat of a question mark. Hospitality, CBD hospitality for people like you and me who travel for work, not doing that great. Hospitality, well located in vacation spots, is still doing extremely well and is getting fantastic RevPAR. or revenue per available room. And so that's been a highlight, and a lot of people are putting capital there. And then finally, office. And office is the big challenge. Office is the one that everyone's watching. Office is the one that everyone's kind of questioning. Can it work its way out, or does a huge amount of office inventory need to be repurposed to either multifamily or some other type of use, just because people aren't going to be going back to B and C class office buildings across the country?
Yeah, I mean, especially if we do get a recession, depending on how long or how steep it is, you have to start thinking about fixed costs, right? And that's, now that we know how to operate in a hybrid environment, it could continue to be a challenge for 2023, potentially 2024. Besides the fact that we can work remotely. But let's talk about Walker and Dunlop specifically, because you've been busy. You've made a number of growth acquisitions.
We have been busy, as we typically are. We're really lucky to have built a business model that has durable revenue streams. And so while transaction volume is always very important to us, and we're trying to do as many loans or as many sales as we possibly can, we also have a very scaled servicing portfolio. And one of the nice things for us is we also have significant escrow deposits on the loans that we've made. And so when the Fed fund rates goes up, we start to make money off those escrow deposits, which essentially evaporated during the during the pandemic, when the Fed brought short-term interest rates down to zero. And so we made 3 acquisitions last year, one in the technology space, one in the affordable housing space, and one in the research space. And we're feeling very good about those. We could have invested, Jill, in what I call pro-cyclical businesses. So we could have put more capital into acquiring another brokerage business or another lending business, and we didn't. And in hindsight, I'm extremely happy we didn't, because as I sat around in Q3 and looked at all of our business lines and who was on budget and off budget for the year, the only 2 business lines that were on budget for the year were Zelman, which is our research division, and Alliant, which is our affordable housing division, the 2 big acquisitions we made last year. And so it's nice to see that we've made, they're not necessarily counter-cyclical acquisitions, but they're very stable acquisitions, which is great to see.
All right, Willy, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Always appreciate it, Jill. Thank you.